bring in Cinthia Murphy, VettaFi investment strategist, for this week's ETF report sponsored by Invesco QQQ. Great to have you here in studio with us. So let's just begin. Why are we seeing some of these inflows, and to what extent is it analogous to events that we've seen in the past where there is a ramp up in some of the defense prioritization among investors?
You know, when it comes to thematic investing, defense has been one of the biggest themes so far this year, outside of protection, things that we're going to talk in a minute about. And, you know, the news keeps supporting this as a good area of the market to be in. So defense stocks are primarily industrial plays, but a lot of them have more and more tech stocks because defense today is both an industrial infrastructure effort. It's also a technology effort, an AI effort. When you think about drones and all the new technology you're using for combat. And this week we had the NATO news where they're really upping their budget for defense spending. They went from 2% of the GDP commitment to 5% GDP commitment. And not only that, but these countries have to actually show on an annual basis their plan. How are they going to allocate that budget? How are they spending that money on actual defense equipment and strategy? So it's a theme that just keeps on giving. I mean, some of these stocks, Rheinmetall, which is one of the biggest defense stocks, it's a German company, is up over 250% in the last year. Yeah. These are really, really strong performers, and investors are buying the ETFs that tap into that space.
Well, and Simeon, Cinthia mentioned a great point in that the battlefield is very different right now, because especially with some of the foreign actors that might try in times of conflict to tap into things like energy grids or natural resources. That also takes the mindset to what needs to be done within cybersecurity, what is already being done, and where investors could also be thinking of that as an annexed defensive play.
Yeah, I think maybe one of the questions is how insulated are these companies from the broader economy? Let's take the NATO uptick in spending. Let's make kind of a bear case that they can't quite run deficits. We know they said they're going to run bigger deficits than they have in the past, but they can't do it like the US does. So let's suppose they keep their commitment, but it takes a nick out of their broader GDP growth. Are the defense names and the cybersecurity names narrow enough to benefit without the downside of perhaps a little touch of weakness in other parts of the European economy?
I think it remains to be seen, but if you think about, I mean, we're talking arms dealers, we're talking about, technology, airplanes, like in the US would be like Lockheed Martin, Northrop Grumman. I mean, they're different companies that are, kind of swimming above that pond because that market is so strong right now. And I think the especially strong plays here are Europe-based plays more than the US, because it has really been that effort there. So when you look at funds that invest primarily in Europe defense, like EUAD, that fund is up 65% so far this year. When you look at, say, SHLD, a shield, which has 50% US, 50% global, that fund is up maybe 50%. So really the play really is the European companies, because they are committed to investing in these businesses and making it happen.
You know, one of the other areas that you flagged to us as well, gold miners, still one of the year's best performing ETFs. What is the outlook for the second half of the year, given that we'd already seen some of the highs that were just mind-blowing that we were able to get to, and how much of those flows could still see momentum from here?
Yeah, Simeon, we've been in this business long enough to know that gold miners ebb and flow. It's like almost every 5 years they have their moment in the sun, and then nothing happens.
And they don't always do what gold does.
And then they bust.
Yes.
This year they're outperforming gold 2-to-1, basically, 60% to 30%. All the conversation, JP Morgan just came out and pegged the price of gold at $4,000 by mid next year, which is another big leg up from where it is today. And if you look at Q1 earnings, I think that's a big catalyst here is Q1 earnings show these companies beating their earnings.
Yeah.
Big, like Newmont, I think beat earnings per share by more than 30%.
Yeah.
So they are really resilient, and they're doing well, and folks are buying it.